Hello ladies and gentlemen. Whoever is watching, I hope you're well and enjoyed this video about how I made my own portfolio of stocks. And now let's have a look at the Excel. I have a lot of sheets on this Excel file and most of them are about individual stock data. And each stock has the following information: the date, the stock price, the monthly stock prices, and the return on these stocks. And this here is the are the data that I wanted to calculate for each stock. So I wanted to calculate the average return, variance, standard deviation, and risk to reward ratio. As for average, I just used the average function from Excel. And as for the variance, I had two ways. The first one is the traditional one that we all took in class, which is getting the excess return and then putting it power 2. After that, I just got their sum and divided it by n minus 1. In this case, n was equal 13, so 13 minus 1 equal 12. And after getting the variance, I just um, put it under the square root to get the standard deviation. And as for the risk to reward ratio, I just divided the standard deviation by the average return. The second way is much simpler and easier and saves a lot of time, which is using Excel function for variance equal var.s and then putting the sample. And as for the standard deviation, standard deviation dot s and then putting the same sample. And as you see here, we've got exactly the same numbers. So I did this for all of the stocks that I had, which were about 28 stocks, and then I decided on the stocks based on the lower risk to reward ratio. And then I started working on my own portfolio, and as you can see here, I just gathered all of the information for all of the stocks. So these are the stocks right here. This table is representing the return for each stock for each month. And right here, this table is representing the average for each stock, average return, standard deviation, and variance for each stock. And here I have the excess return for all of the stocks over the 1 year period. And I needed this in order to calculate and build the variance covariance matrix, which is right here. In order to get the variance covariance matrix, I first put the tickers for my stocks in order, both vertically and horizontally. And then I started to calculate the covariance by this formula here, the M mult transpose, and I transposed the excess return by itself and then divided by n minus 1. After that, I dragged this formula to all of the cells and I got these values. What I want to show you here and what I want to make obvious is this yellow diagonal line right here. So this diagonal line is representing the covariance between each stock and itself. So basically the covariance between the stock and itself is equal to the variance. To make sure that I am moving in the right direction and I have the correct values, I had to check these. So for example, Jufu here is having a covariance of 1.93 and CAED has a covariance of 0.05%. So if we get back here, we're gonna find that this is exactly the same as their calculated variances, so everything is correct. After building my variance covariance matrix, I started to work on my portfolio weighting strategy right here. And as you can see, I have 7 weighting strategies, and 4 of them involve Excel solver, and one of them is about market capitalization weighting strategy, lower risk percentage weighting strategy, and the equal weighting strategy. For all of the stocks, I calculated the following: the summation of the total weights, the return, compounded annualized return, annual return, variance, sigma, annual sigma, or the standard deviation, risk to return ratio, and Sharpe ratio. Simply to get the equal weight, I just divided 100% divided by the 21 stocks, and I got this number. And for the maximizing and minimizing the weights, I just used the Excel solver. So if we're gonna take maximizing the Sharpe ratio as example here, I just used the Excel solver. in order to maximize the objective function, which is the Sharpe ratio, and then changing the variable cells, which are the weights of my stocks. And my constraints were that I don't want to invest in one stock by more than 25%, and I do want to invest on all stock, and this having a value of greater than or equal to 0, and the summation of all of my stocks must equal to 1. As for the last two strategies, which is the market capitalization and lower weight, I had to calculate them in a separate sheet right here. So for the market capitalization, I had to get the market capitalization for all of the stocks, or the market value for all of the stocks that I have, and then I got their sum. After that, I just divided the market cap for each stock by the total. And as for the sigma or the standard deviation, I just got the standard deviation for each stock, and I wanted to allocate a higher weight for the lower standard deviation stock. So I had to get the complementary for each stock, so I just subtracted each standard deviation from 1, and then I got their summation, and after that I just divided each 1 minus standard deviation divided by the total sum of them in order to get their weighting. And of course we have to check that their sum is equal to 1, and it is. So after that I just copied them here, and I got the return by using the m-mult transpose, or using even some product function to get the weights by the monthly return, and I did this for all stocks. And this was the equation for the annualized return, and if we the compounded annualized return, and if we don't want to compound it and just getting it relative to the monthly return, we just get multiplied by 12. And to get the variance, we're gonna use the covariance matrix. So I use this function here, m-mult transpose, and I transpose the weight of each strategy by the covariance matrix, and then by the weights again. As for the sigma, it's just the square root of the variance, and to get the annual sigma, we multiplied by the square root of 12. As for the Sharpe ratio, I had to get the risk-free rate. So I got the risk-free rate on a 10-year government bond of 17.43%, and I got the equity risk premium from Demodran for Egypt. In order to get the total market return, I got the risk-free rate plus the market risk premium in order to compare my portfolio return to the Egyptian market return. Getting back to the Sharpe ratio, I just subtracted the return, and I put the return and subtracted the risk-free rate, and then divided by the portfolio sigma. After that, I chose the strategy to maximize Sharpe ratio, so I chose this portfolio weights allocation right here. After choosing these weights, I wanted to compare also my strategy to EGX 100 because it has a wider range of securities or stocks. So I got the data for the same over the same period, and I calculated the average return, variance, and standard deviation. Um, what needs to be noted here is that the standard deviation for EGX 100 is much higher than the monthly standard deviation for my portfolio, and this is a good sign because simply my portfolio is safer than the market. After that, I calculated the beta. Unfortunately, I calculated the beta after investing in Tender. However, the way that I calculated it was by getting the standard the weights for each stock, and then multiply the weight of each stock by its monthly return, and by this I got the weighted average for the returns. And for each month, I just summed the weighted average returns for all of the months, and by that I got the monthly return for my portfolio, and I got the returns for the market return over the same period. And by getting these two columns, I could easily calculate the beta, so I could get the market variance by just using the var function, and the covariance between the market data, the market return, and the portfolio return. And then to get the beta, I simply divided the covariance by the market variance. The second way of getting the beta was using the regression analysis. So I just used the regression analysis and the intercept for AGX return was equal to the beta. So as we can see here, they got exactly the same numbers, so I made sure that my calculations are correct. However, as you see, the beta is really so small, and it's not a good beta because it's approximately equal 0. It means that if my portfolio, if the market increased by uh, by one AGP, the portfolio will increase by 0.02, which is very low, and it's close to 0. When I calculated the portfolio return using CAPM, which is risk-free rate plus market risk premium, multiplied by the beta, it was really close to the risk-free rate. So this is not attractive for investors because they can easily invest in a risk-free rate. However, I wanted to see why did that happen. I saw that there is no distinct correlation between the market portfolio and market returns, and I also graphed the returns for both of them, and I found that over the 12 months period, only in 6 periods they were moving in the same direction, and the portfolio was outperforming the market. However, in the last periods, from starting from here, they were moving completely in different directions, and this is maybe attributed to the result of a very small covariance and so the very small beta. We can see that the reason behind these is that the stocks like IREX or GMCI have higher weights, and they were having negative returns when the market was having a positive return. So they affected the portfolio return. So in conclusion, changing either the weights or the combination of stocks would have changed the value of the beta. And last but not least, after I calculated the beta and invested in all of the stocks, I had to analyze the performance of my portfolio daily. I started investing in 25th of May, so these data are from 25th of May until 9th of June. I had to put the data for each stock manually and daily, but there is a very good formula here in Excel that can extract the daily prices or daily changes in each stock. So for example, if you want to get the stock for Apple, we just type the ticker or the name of the company, then click here and choose Apple, and then using this we can extract from this cell anything that we need, like the price or anything about the company, like industry or name or anything. But this wasn't unfortunately available for the Egyptian stocks, so I had to put everything manually. So for example, for this stock right here, I just get the number of stocks initially invested in multiplied by the market price. I did this for all of the stocks, and then right here I just was summing up all of the market values for each day, and I would get the amount of cash daily as well. As you can see, there were variances here because, for example, during this day I just bought this number of stocks with this value, so the market value was changing due to buying and selling. And we can see that this is really obvious in this graph right here. At the end of the period, I calculated the return on each stock by simply getting the selling price minus the purchase price, and I summed all of the returns for all stocks, and simply after that I just divided this amount by the initially invested amount to get the percentage of the return, and I got a return of 1% over a 2-week period. And then at the last of the period, I wanted to compare it to the market, so I compared it to AGX 100, 30, and 70. And I saw that my portfolio is outperforming AGX 30, but unfortunately it underperforms AGX 100 and AGX 70. But if I calculated the return of my portfolio and AGX 100, I would see that it was closely predicted by beta, and I believe that this is a good thing. And at the end, that was all about the portfolio project. I hope that you enjoyed it, and thank you so much.